The future of US banks has been a hot topic lately. With economic uncertainty and market fluctuations, you might be wondering if they'll recover soon. Today, we'll dive deep into the state of US banks and their prospects for recovery, so stay tuned. To understand where we're heading, we need to know where we are. US banks have been facing numerous challenges, including low interest rates, stricter regulations, and competition from fintech companies. As a result, profitability and growth have been limited in recent years. For example, my friend's business with a good credit score was just given an operating line at 14%. There's zero chance he's going to use that in a major way, and this of course signals banks are not willing to take risks. But the big question is, when can they bounce back? Don't forget to like and subscribe to our channel for more informative content on finance, business, and the economy. And stay until the end to receive my bonus tip on potential opportunities for you to take advantage of this situation right now. So let's dive in. Factors affecting US banks' recovery. There are several factors that will impact US banks' recovery. These include economic growth, interest rates, regulatory changes, and technological advancements. Let's break down each of these factors and their potential impact on the banking industry. Economic growth and interest rates. Economic growth is vital for a healthy banking industry. A strong economy means more lending and investing opportunities. Interest rates also play a significant role. Higher interest rates can boost banks' profitability as they can charge more for their loans. However, if interest rates rise too quickly, it could lead to a slowdown in borrowing and economic growth. Keep an eye out soon for the Fed to start slowing down their rate hikes, because when they start to decrease rates, there will be some great opportunities to jump in. Regulatory changes. Regulatory changes can significantly impact the banking industry. While regulations are necessary to maintain a stable financial system, excessive regulations can hinder growth and innovation. The future of US banks will depend on striking the right balance between maintaining stability and fostering growth. Certain banks that over-leverage or lend or make bad investments should be squeezed out. A few weeks ago, it was announced that Treasury Secretary Janet Yellen is about to re-examine US banking regulations to tighten them up and to avoid any bank from going under the next time the Fed raises rates to slow inflation. Use this to your advantage when jumping into the market by investing in strong banks. Technological advancement and competition. Technology is changing in the banking landscape. Fintech companies are offering innovative financial services, often at lower costs. Traditional banks must adapt and embrace technology to stay competitive. They need to invest in digital banking, cybersecurity, and customer experience to retain and attract customers. We see this where banks such as Bank of America and Santander are utilizing crypto and blockchain technology, yet not offering direct exposure to trading it. If they have this ready to go when the SEC is ready to open the floodgates, it will massively improve their profitability, aka good time to look for huge opportunities. The future of US banks. Will US banks recover soon? The answer is not straightforward. The recovery will depend on how banks adapt to the changing environment and how they leverage opportunities to grow. In the short term, we might see some consolidation and mergers in the industry, like we just saw with siliconvalleybank and Credit Suisse. In the long run, the banks that embrace technology, adapt to regulatory changes, and focus on customer experience will likely thrive, so invest accordingly. The impact of COVID-19 on US banks. The COVID-19 pandemic has significantly impacted the global economy, and US banks have not been immune. Banks have faced increased loan losses and a higher volume of non-performing loans due to the economic downturn. The pandemic has also accelerated the shift towards digital banking and remote work, forcing banks to adapt quickly. The banks that can successfully navigate the challenges brought on by the pandemic will be better positioned for recovery. International competition and global banking landscape. US banks are not only facing domestic challenges, but also international competition. As emerging markets grow and global banking becomes more interconnected, US banks will need to stay competitive on the world stage. This includes expanding their global reach, adapting to different regulatory environments, and understanding the unique needs of international customers. Potential opportunities for investors. All right, you've come this far, and I promised you bonus tips. Here they are. First, analyze the bank's financial health. Look at key financial metrics, such as return on assets, return on equity, and net interest margin. 2. Assess the bank's risk management practices. A strong risk management framework is essential for navigating uncertain economic conditions. 3. Evaluate the bank's digital strategy. Banks that invest in technology and digital services are more likely to stay competitive and attract new customers. 4. Consider the bank's exposure to interest rate fluctuations. Banks with a well-diversified loan portfolio and a solid deposit base may be better prepared for potential interest rate changes. 5. Keep an eye on regulatory changes. Stay informed about potential regulatory changes that could impact the banking industry and affect your investments. Thank you for joining us on this deep dive into the future of US banks. We'll continue to monitor their progress and keep you up to date on any significant changes in the industry. Don't forget to like and subscribe to our channel for more informative content on finance, business, and the economy.